What if I told you there is a book on investing that the master himself, Warren Buffett, not only recommended, but said he read twice? Let's start with a name everyone knows, Warren Buffett. I don't need to tell you he is a legend, but here's a fun fact you might not know. Buffett almost never publicly recommends investing books. His philosophy is that the core principles are simple. If you get it, you don't need more books if you don't. No amount of reading will help, but in 2011, he broke his own rule for one book, he said, and I quote, "I've read it twice. Its wisdom is something every serious investor needs to reflect on over and over. Now, a book that makes the Oracle of Omaha spend his precious time reading it twice isn't your typical feel-good financial fluff. So, we have to ask, who is the guy who wrote this thing? The author is Howard Marks. When he wrote this book, he was 66 years old, a bit younger than Buffett, and a true icon who is both a brilliant thinker and a master in the practical world of investing. In 1995, he co-founded Oaktree Capital, which today manages over $80 billion in assets. To put that in perspective, that is about 1/5 the size of Buffett's entire Berkshire Hathaway empire in the world of asset management. That it is the big league. But let's talk real numbers. Mark's personal fortune is around $15 billion. To be in the same wealth stratosphere as Buffett tells you one thing. This guy's investment skill is the real deal. But it's not just about the money. What Buffett truly respected was the deep connection they shared in their investment philosophy. Marx himself has said, "The investor I admire most is Warren Buffett. He can take the most complex ideas and explain them like you are just having a chat, and that respect is a two-way street." Buffett once said, "When I see memos from Howard Marks in my mail, they're the first thing I open and read." Now, these memos are Marks' signature. Just like Buffett's annual letters to shareholders, they are required reading for professional investors worldwide. And this book, the most important thing, is basically a collection of the greatest hits from 20 years of those memos. He distilled a lifetime of hard-won wisdom into one place. So, when Buffett read it twice, he was really revisiting the core truths of investing that he himself lives by. Which brings us to the big question. Why does a master like Buffett need to read someone else's book on investing? There are two core reasons, and they get right to the heart of what this is all about. First, great minds think alike. Both Buffett and Marx are disciples of the legendary Benjamin Graham, the father of value investing. They both believe in the fundamental principle of buying value, not chasing hype. Open this book, and you'll see Marx quoting Buffett in almost every chapter. That's not just for show. It's because their logic is perfectly in sync. They both believe buying a stock is buying a piece of a business. They both despise chasing hot trends. They both agree that risk isn't volatility. It is the permanent loss of capital. This shared philosophy made Buffett feel like, this guy gets it, he gets me, and he gets the essence of investing. But the second reason is even more critical. They have different superpowers. Buffett's genius is taking profound investment philosophy and making it simple enough for anyone to understand. His classic line, "Be fearful when others are greedy, and greedy when others are fearful," perfectly captures the essence of contrarian investing in a single sentence. Marx's genius, on the other hand, is in the practical application. He spent his entire career focused on securities and stocks, unlike Buffett, who later moved on to acquiring entire companies. So, in this book, you won't find grand theories about corporate takeovers. What you will find are answers to questions that matter to us, the everyday investors. How do you actually analyze a stock's value? When the market is panicking, how do you decide whether to buy? How do you manage your portfolio so you don't get wiped out? It's intensely practical. For example, Buffett will tell you, buy $1 worth of value for 50 cents. But Marx will show you, How do you calculate that dollar of value? When do those 50-cent opportunities actually appear? And what if you buy and it drops to 40 cents? Should you buy more or cut your losses? For most of us who just want to grow our money steadily in the stock market, these details bridging the gap from idea to action are more useful than a collection of quotes. So now you see why Buffett read it twice. The book confirms his own core beliefs while also diving deep into the practical, on-the-ground tactics of stock investing. It is the perfect blend of why and how. For us, the takeaway is even more direct. We can learn from Mark's second-level thinking to see the market differently, find bargains, and control risk, allowing us to sidestep the traps that catch most investors. But to master these methods, we have to start with the most fundamental thing of all: our mindset. After all, to make money in the market, you first have to understand why most people lose it. Why do we always chase highs and sell lows, even when we know better? This brings us to the concept Marx hammers home again and again: the difference between first-level thinking and second-level thinking. Part 2. The two mindsets that separate winners from losers. Last time, we talked about why Warren Buffett is such a huge fan of Howard Marks's book. The bottom line is this: Marx takes the brilliant but abstract idea of value investing and turns it into a concrete playbook and actually use. But the first step isn't learning how to read a financial statement. The first step is getting your head straight, learning how to think. The vast majority of investing mistakes aren't technical. They're psychological. You didn't do the math wrong. You thought wrong. Marx dedicates a whole chapter to this, breaking down thinking into two types: first-level thinking and second-level thinking. Let's break this down today, because once you truly understand the difference, you'll be able to dodge about 80% of the traps in the market. First up, the most common mindset: first-level thinking. What is it? Simple. It's superficial and follows the herd. You think and do what everyone else is doing without any deep, critical thought. Let me give you a few examples, and you'll get it instantly. Example 1. You see a news headline: Company XYZ's profits are up 50%. The first level thought is, wow, great news. The stock is going to the moon. I gotta buy. Example 2. The market has been dropping for a week straight. The first level thought is, this is the start of a crash. I have to sell now before I lose everything. Example 3. Everyone at the office, on television, and on social media is saying, if you are not in on AI stocks, you are going to miss out. So, without a second thought, you jump in and buy an AI-focused fund. This thinking is instant and requires almost no effort. And there is a strange comfort in it, right? You figure, if I am wrong, at least I am not the only one losing money. But that's exactly the problem. Investing isn't a team sport where there is safety in numbers. In fact, it is the opposite. The more obvious and widely accepted an idea is, the more likely it is to be a trap. Think back to the dot-com bubble. A company with comms in its name was seen as a can't. Miss stock. The first-level thinkers were all shouting, the internet is the future. It is a new paradigm. It can only go up. But what was really happening? The stock prices had already baked in decades of optimistic growth that might never happen. People were buying hope, not value. And when the bubble burst, countless people who jumped in at the peak were financially wiped out. This is the classic trap of first-level thinking. You only see the immediate price movement, not the underlying value. You follow emotion, which leads you straight into the buy high, sell low cycle, getting fleeced again and again. Marx puts it perfectly in the book. First-level thinkers look for simple formulas and easy answers. But in investing, there are no easy answers, because any logic that everyone knows is already reflected in the price. Think about it. Good news is public knowledge. By the time you hear it, Thousands of professionals have already acted on it, and the price has already gone up. If you buy then, you are just providing an exit for the early birds. So, what is second-level thinking? It is not just doing the opposite. It's about thinking deeper and further. While others see what happened, you ask why it happened and what might happen next. While others see the simple story, you look for the plot holes and the risks everyone is ignoring. Let's replay our examples with a second-level mindset. The company whose profits jumped 50%, a second-level thinker asks 3 questions. Is this 50% growth real? Did it come from their core business or from a one-time event? Like selling a building or a government handout. Is this growth sustainable? If the company made face masks during a pandemic, can they keep that momentum going after the pandemic? How much of this good news is already priced into the stock? If the market already expected this, the stock price might not move at all. The market that is crashing. A second-level thinker thinks, what is the real reason for the drop? Is the entire economy collapsing? Or is this just a short-term panic? If it is just a panic, the company's intrinsic value hasn't changed. A lower price for the same asset is a bargain. Isn't this a buying opportunity? Even if the economy is in trouble, how much of that is already reflected in the price? Has it overshot to the downside? A company worth $20 might drop to $15. Even if the economy is still weak, $15 might be cheap enough. Mark shares a classic case from his own career. In the 1990s. Junk bonds, bonds from less creditworthy companies, were toxic. Everyone thought buying them was financial suicide, a classic first-level thought. But Marx and his team applied second-level thinking. Not all junk bonds will default. Many companies are just in temporary trouble because everyone was terrified. The yields on these bonds were incredibly high, around 15%. Even if a small percentage defaulted, the returns from the rest would more than make up for it. They also saw that the economy was starting to recover, which meant the risk of default was actually decreasing. They loaded up on junk bonds and made a fortune. C. Second-level thinking isn't about being a contrarian for the sake of it. It is about deep, fact-based analysis. It's not thinking about a single outcome. Will it go up or down? But about a range of possibilities and their probabilities. It is not about what everyone thinks, but why they think it and where they might be wrong. So why doesn't everyone do this? Marx points to 2 painful truths. Psychological comfort. Going with the crowd is easy. If you are wrong, you are not alone. But if you go against the herd and buy an unloved stock, you'll be questioned by everyone. If it drops a little more, you'll even question yourself. That feeling of isolation is too much for most people to handle. Cognitive laziness, deep thinking is hard work. First-level thinking takes 5 minutes. Read a headline, make a decision. Second-level thinking might take days of research, reading reports, analyzing trends, calculating value. Most people want a get-rich-quick scheme, not homework. So how can we, as regular investors, start building this crucial skill? Marx offers 3 practical tips. The 10-minute pause. When a stock soars or crashes, don't just react. Stop, take a breath for 10 minutes. Ask yourself, am I about to make a decision based on logic or on emotion? This single habit can save you from 80% of impulsive mistakes. Actively seek out the other side. If you are bullish on a stock, don't just read the good news. Actively search for the bearish arguments. Why do people think it will fail? If everyone is saying the same thing and you can't find a single dissenting opinion, be extremely cautious. That is often a sign of a market extreme. Calculate your margin of safety. This is the core of second-level thinking in practice, and we'll dive deeper into it later. In short, Never pay full price. If you calculate a stock is worth $10, wait until you can buy it for $8 or less. That $2 discount is your safety net. It protects you if you are wrong and supercharges your returns if you are right. By now, you should see why Marx calls second-level thinking the foundation of investing. It's not about predicting the future. It is about learning how not to be fooled by the present. Part 3 is the market smart or crazy, and how to profit from both. So we've talked about using second-level thinking to beat market emotions. But does that mean you can outsmart the market all the time? Not so fast. To win the game, you first need to know when the market is playing rationally, and when it is completely losing its mind. Today, we're going to crack one of the central puzzles in finance. Is the market actually efficient? Understand this, and you'll know exactly when to trust your deep thinking and when to just go with the flow. First, let's talk about a famous theory called the efficient market hypothesis. It sounds complicated, but the idea is simple. It says that all available information, every news report, every earnings release, every analyst rating is instantly and fully reflected in a stock's price. Think you can buy a stock after reading good news too late. The price already jumped. Think you can sell on bad news. Sorry, it is already dropped. And to some extent, this is true. Think about giant, well-known stocks like Apple or Microsoft. They are followed by thousands of professional analysts every single second. The chances of you, a retail investor, finding a piece of information that they've all missed is practically zero. This is why Buffett largely stopped hunting for bargains among the biggest, most popular stocks. He knew those markets were just too efficient. But here is where Howard Marks takes it a step further than the academics. He argues that the market isn't always efficient. It is partially efficient, sometimes it is rational, and other times it is completely bonkers. So what is the one thing that can make an efficient market suddenly inefficient? One word: emotion. The efficient market hypothesis rests on a flawless but impossible assumption that all investors are perfectly rational all the time. But in the real world, human greed and fear constantly push prices to absurd extremes, far away from their true value. Think about the COVID crash in March 2020. The entire market plummeted in a wave of panic. Solid, profitable companies saw their stocks drop 30 to 40% in a matter of weeks, not because their business was failing, but simply because fear was everywhere. Was the market efficient then? Absolutely not. Prices were driven by emotion, not facts. The powerful rebound that followed was simply the market returning from an inefficient state of panic back to a more efficient state of rationality. The people who bought during the crash were using their second-level thinking to spot that emotional discount. The 2008 financial crisis is another textbook example. Before the crash, greed made everyone believe that housing prices could only go up, making the market wildly inefficient on the high side. After the crash, fear made everyone believe that every bank was going to fail, making the market wildly inefficient on the low side. Marx's key insight is this: market inefficiency shows up most often at the extremes, when everyone is convinced something is either a sure thing or a compete. So how can we use this to our advantage? Marx gives 3 incredibly practical rules. In efficient markets, don't try to be a hero for those big popular stocks and major market indexes. Like the S&P 500, the market is usually pretty smart. Instead of trying to outwit it with frequent trading, the best strategy is often to just buy a low-cost index fund and earn the market's average return. Trying to time your buys and sells in Apple is usually just a donation to your broker. Hunt for opportunities in inefficient markets, but only where you have an edge. This is where you can find true bargains. Look for stocks that are smaller, less popular, or in industries that are currently out of favor. But, and this is critical, stick to what you know. If you are a doctor, you might have a unique insight into a small medical device company that Wall Street is ignoring. That is your hunting ground. But don't venture into areas you don't understand, just because they seem volatile. That is not an opportunity, it is a gamble. Use the consensus meter to gauge efficiency. How can you tell if a market is efficient or not? Listen to the crowd. If everyone, your friends, the media, your Uber driver, is talking about an investment, like AI stocks were in 2023, the market for it is likely efficient or even over-efficient. The optimism is already priced in. Conversely, if an industry is completely ignored or hated, like oil and gas was in 2020, there is a good chance the market is being inefficiently pessimistic, creating potential bargains for those willing to look. Now, this leads to the most important question of all. How do you know if a price is wrong? To say a stock is mispriced, you first have to know its true value. This requires us to master the core skill of value investing. How to calculate, with reasonable accuracy, what a business is actually worth. Only then do you have a benchmark to judge whether the market is being smart or foolish. Part 4. Good company versus good investment. The trap that kills portfolios. If you want to be a good investor, you'll always hear the same piece of advice. Be good companies. Sounds obvious, right? But hiding within that simple phrase is a massive trap that has cost investors fortunes. The reason many people never make money in the stock market is that they confuse buying good things with buying things well. Today, we're going to break down this crucial difference and get to the heart of value investing. How to find a true bargain. Let's start with a classic mistake. Assuming a great company is always a great investment. Think about a world-class company, a household name like Coca-Cola or Disney. Are they fantastic businesses? Absolutely. They have powerful brands, strong cash flows, and dominant market positions. But here is the million-dollar question. Are they a good investment at any price? Absolutely not. Think back to the dot-com bubble in the late 90s. A fantastic company like Cisco was the backbone of the internet. It was a phenomenal business, but its stock price was bid up to a valuation that implied it would become the most valuable company in the world and continue growing at an impossible rate forever. At that price, Cisco was a terrible investment. Anyone who bought at the peak in 2000 had to wait over 15 years just to break even. They bought a good company, but they didn't buy it well. Marx highlights a famous historical example, the Nifty 50 bubble of the 1970s. A group of 50 top-tier, blue-chip stocks like IBM and Coca-Cola were considered so dominant that you could buy them at any price and never sell. First-level thinkers were convinced their fundamentals are perfect, just close your eyes and buy. As a result, their price-to-earnings ratios soared to 80 or 90 times. And then, the bubble popped, the market crashed, and many of these can't-lose stocks fell by over 50%, taking investors' life savings with them. Marx's conclusion is sharp and clear. There is no such thing as a good idea or a bad idea in a vacuum. It is all about the price you pay. A great asset can be a terrible investment if you overpay, and a mediocre asset can be a great investment if you get it cheap enough. So, the key question is, what is this intrinsic value, and how do we figure it out without being a Wall Street quant? Don't worry, it is not as complex as it sounds. Marx boils it down to two core concepts that anyone can grasp: hard assets and real cash flow. Look at the hard assets. What tangible stuff does the company actually own? This includes things like cash in the bank, factories, equipment, and inventory. Add all that up, subtract all the company's debts, and you are left with the net asset value. This is the company's rock bottom, liquidation value. If the company's total stock market value, its market cap is less than this number, you found a situation where buying the whole company is cheaper than just selling off its parts. Look at the real cash flow. This is about the future. How much actual, spendable cash can the business generate year after year? Note, we're talking about cash flow, not profit. Profit can be manipulated with accounting tricks, but count is much harder. A simple way to think about intrinsic value is to estimate all the future cash a business will generate, and then discount that back to what it is worth today. If that number is significantly higher than the current stock price, you found a potential bargain. So, once you understand value, how do you find these bargains in the wild? Mark shares 3 time-tested strategies. Technique number 1. Go hunting where no one else is. The hottest sectors like AI or clean energy today are crowded with investors. Prices are high, and true bargains are almost impossible to find. The real opportunities are often hiding in plain sight, in boring, neglected, or even despised industries. This is where prices can get so low that they become disconnected from reality. This was the logic behind Mark's success with junk bonds. Technique number 2. Always demand a margin of safety. This is your financial seatbelt. If you calculate that a stock is worth $10, don't you dare buy it at $9.5. Wait for it to fall to $8. That $2 -3 discount is your margin of safety. It protects you in case your calculation was a little off, or if the market gets even more pessimistic. With a margin of safety, if you are wrong, you lose a little. If you are right, you win big. Technique number 3. Don't be scared off by short-term bad news. The reason bargains exist is often because a company is facing a temporary problem, a bad quarter, an industry downturn. And the market panics, selling off the stock indiscriminately. But if the company's long-term strengths are still intact, this panic price is a gift. Buying high-quality bank stocks during the depths of the 2008 financial crisis is a perfect example of this in action. And one final, crucial reminder. Buying a bargain is about finding a misplaced jewel, not picking up trash. Some things are cheap for a reason, because they are, in fact, just junk. A company whose business is becoming obsolete is not a bargain. It is a value trap. Mark's philosophy is about finding assets where the price is below the value, not just finding things with a low price tag. So now the core idea is clear. Figure out what something is worth, and then wait patiently for a chance to buy it for far less. But this raises one final, critical question. Even if you find a bargain and buy it, how do you make sure you don't get wiped out? The market can keep falling, and your judgment could be wrong. This brings us to the most important thing of all, understanding and managing risk. Part 5. The market's rhythm. Riding the cycle instead of being crushed by it. We've talked about finding bargains, but here is the reality. Bargains don't just appear randomly. They tend to show up in bunches during very specific phases of the market cycle. Howard Marks wrote something profound in his book. I'm absolutely sure about one thing. Cycles will always prevail. Everything in life, the economy, the markets, and even our own emotions, moves in cycles. And the main reason most people lose money, chasing high prices and panic, selling at the bottom, is that they have no idea how to read the cycle. They are constantly out of sync with its rhythm. Today, we're going to demystify this compass of investing, so you'll know when to be patient and when it's time to be greedy. First, don't overcomplicate the idea of a cycle. It is simply the natural process of things moving from one extreme to another, and then eventually to the middle. Just like we have 4 seasons, the economy has periods of boom and bust. The stock market has bull and bear markets, and our own psychology swings between optimism and pessimism. History is filled with examples. In the late 1990s, during the dot-com boom, everyone believed a new era of permanent prosperity had arrived. In 2008, during the financial crisis, many believed the entire financial system was on the verge of collapse. Greed was followed by fear, which was eventually followed by greed again. the cycle repeats. And we see these cycles all around us. The investment fad cycle. In 2021, ARK Invest and disruptive innovation. Funds were the hottest things around by the end of 2022 after a massive crash. Those same funds were untouchable. The housing cycle, for years people believed housing prices only go up and took on massive debt. After a correction, that sentiment flipped to prices will never recover. The driving force behind all of this is the cycle of investor emotion. We get greedy when things are going up, and we get fearful when they're going down. And most people don't even realize they're being controlled by the cycle. They fall for the most dangerous 4 words in investing. This time is different. To make this even more practical, Marx uses a brilliant analogy. The pendulum. Imagine market sentiment as a giant pendulum. It rarely rests in the middle at the point of rationality. Instead, it is constantly swinging back and forth between 2 extremes, greed on one side and fear on the other. When the pendulum swings to the extreme of greed, this was the dot-com bubble, or the crypto mania of 2021. The signs are always the same. Everyone is talking about how much money they're making. Your friends who never invested before are suddenly giving you stock tips. Valuations are sky high. Companies with no profits are worth billions. This time is different. Narrative is everywhere. At this point, bargains have vanished. Everything is overpriced. Buying here means you are likely holding the bag for someone else. When the pendulum swings to the extreme of fear, this was March 2020, or the depths of the 2008 crisis. The signs are just as clear. No one wants to talk about investing. The news is filled with doom and gloom. Valuations are at rock bottom lows. The market's PC ratio is in the single digits. The consensus is that the economy is finished and things will only get worse. This, right here, is when bargains are everywhere. Great companies get thrown out with the trash. Their prices crushed by pure panic. Marx's key insight is this: the pendulum never stays at one extreme forever. Once it reaches its peak on one side, its journey back to the other side is inevitable. Most investors lose money because they do the exact opposite of what they should. They buy with the crowd when the pendulum is at greed, and they sell with the crowd when it is at fear. They are perfectly, tragically, out of sync. So how do we know where the pendulum is? Marx gives 3 simple, observable clues. Look around you. The behavior of the average person is your best indicator. If your colleagues and family are all excitedly talking about their stock market winnings, the pendulum is near greed. If everyone is silent, scared, and avoiding the topic, it is near fear. The crowd is a mirror of the cycle. Check the valuation. Valuation is the market's temperature. Look at the P/E ratio of a Meiji index like the S&P 500. Is it high or low compared to its historical average? If it is in the top 20% of its historical range, things are hot. If it is in the bottom 20%, things follow the money, are new investment funds, attracting record amounts of cash. That is a sign of overheating. Are funds seeing massive withdrawals and struggling to attract new money? That is a sign of fear and opportunity. But here is the most important warning. Knowing the cycle does not mean you can predict the exact day or week it will turn. We never know how long an extreme will last. Therefore, the goal is not to time the absolute bottom or the absolute top. That is impossible. The goal is to act within the right zone. Be cautious and sell a little when everyone is greedy. Be brave and buy a little when everyone is fearful. If you can simply do that, you'll be light years ahead of the crowd. But this leads to one final challenge. Even if you buy at the fear extreme, the market can keep going down, and you will face losses on paper. How do you handle that pressure? How do you distinguish between normal market volatility and a genuine permanent loss? This brings us to the core of it all. How to truly understand and manage risk. Part 6. The art of being a true contrarian without catching a falling knife. Understanding the market cycle gives us a map of when to act. Knowing you should buy when there is blood in the streets and actually doing it are two completely different things. This is where we talk about contrarian investing. A lot of people think it is simple. When everyone sells, I buy. When everyone buys, I sell. They try it once, get burned, and give up forever. They either buy way too early and get crushed, or sell way too early and miss a massive rally. Today, we're going to break down what separates the true contrarianism of legends like Howard Marks and Warren Buffett from the dangerous fake contrarianism that destroys wealth. First, you absolutely must understand this difference. It is everything. What is true contrarianism? It's buying when others are panic, selling due to temporary emotion. After you've done the calm, rational analysis and concluded that the asset's long-term value is still a example. During the 2020 COVID crash, airline and cruise stocks were sold off as if they were going to zero. A true contrarian would analyze their balance sheets to see which ones had enough cash to survive a year-long shutdown. Buying one of those financially strong companies at a panic-driven price was a true contrarian move. You were taking advantage of an emotional error by the market. What is fake contrarianism? It is buying something only because its price has fallen a lot, while ignoring the fact that its underlying theory. Example, a company like Blockbuster in the mid-2000s. The stock was plummeting. A fake contrarian would say, "It is down 80%. It must be a bargain." But they'd be ignoring the fundamental reality that Netflix and streaming were making their business model obsolete. This isn't investing. It is catching a falling knife. You are ignoring a fundamental truth that the market is correctly identifying. Marx is crystal clear on this. The essence of true contrarianism is having the courage to ignore emotion because you have a strong grasp on value. Fake contrarianism is ignoring fundamentals just because you are attracted to a low price. So, before you ever make a contrarian move, you need the conviction that comes from deep analysis, not blind arrogance. Ask yourself these 3 questions. Is the crowd selling for emotional, short-term reasons or for fundamental, long-term reasons? Is the problem a temporary headwind, like rising interest rates, or a permanent impairment, like a product becoming obsolete? How much of the bad news is already priced in? Let's say a company announces its profits will fall 10%. A rational price drop might be 15%. But if the market panics and the stock drops 40%, the price has likely overshot the reality. That is an opportunity. Is my margin of safety wide enough? This is your lifeline. If you think a stock is worth $10, don't buy it at $9.5. Wait for $8 or even $7. That buffer is the insurance you buy for the possibility that you are wrong. A contrarian investment without a margin of safety is just reckless gambling. Once you have the right mindset, it is all about execution. Here are 3 strategies Marx uses to wait for the perfect pitch. Strategy 1. Wait for the storm to calm down a bit. Don't try to be the hero who buys on the day of the crash, when the market is down 5%. Wait for a few days of stabilization. When the initial wave of panic selling has subsided, you won't catch the absolute bottom, but you'll enter at a much safer point and avoid immense psychological pressure. Strategy 2. Let the price come to you. Use your calculated margin of safety as your entry ticket. If the price isn't there, you don't buy. Period. Discipline is a contrarian's best friend. Strategy 3. Wait for a green shoot from the business itself. A contrarian bet isn't on a price rebound. It is on a value recovery. After the price is cheap, wait for a signal that the business is stabilizing. Has revenue stopped declining? Is cash flow turning positive? These signs dramatically increase the probability that your contrarian bet will pay off. And finally, the most important rule of all, even when the perfect opportunity arrives. Nebraska go all in at once. Marx is a huge advocate for buying in stages. Divide the money you want to invest into 3 to 5 parts. Buy the first piece when the price enters your margin of safety zone. If it keeps dropping, buy the second piece at an even better price. Continue until you've built your desired position. Always keep some cash on the side. This keeps you in control. If the price drops, you are happy because you can buy more cheaper. If the price rises, you are happy because you are already invested. It solves the psychological torment of fear of missing out versus fear of being wrong. A final reminder, being a contrarian does not mean being stubborn. If you buy a stock and later discover your original analysis was flawed, e.g., you uncover fraud or a new competitor permanently changes the industry, you must be willing to admit your mistake and sell. That is not selling out of fear. It is selling because the reason you invested is no longer valid. True contrarian investing is a complete system. But even with the perfect system, we still face one final, formidable opponent, ourselves. Part 7. Your biggest enemy in investing is you. Welcome back. We've covered second-level thinking, market cycles, value investing, and the art of being a contrarian. With all these powerful tools, victory should be guaranteed, right? Unfortunately, no. Howard Marks wrote one of the most brilliant lines in any investing book. There are 2 main reasons why investors lose money. They know nothing, or they know everything. The first group loses from a lack of knowledge, but the second group people, like us who have studied the methods, often falls into an even more dangerous trap, overconfidence. We become, in his words, the know-it-all fool. Today, we're going to confront the 3 most common and deadly psychological traps that even smart investors fall into. Trap 1, the forecasting trap. When we start investing, it is easy to believe that success depends on correctly predicting what is going to happen next. Will the economy grow? Will the market hit a new high? But, let's be honest. How many experts at the start of 2023 predicted the S&P 500 would rally over 20%? How many predicted the 2020 crash or the 2008 crisis? We are obsessed with prediction because being right feels so good. But Marx, with over 40 years of experience, tells us plainly, I have never met anyone who can consistently predict the market. If the pros with their supercomputers can't do it, what makes us think we can? How to avoid it? Stop trying to predict and start trying to prepare. Don't ask, will the market go up? Ask, if the market goes up, how will my portfolio do? And if it goes down, what is my potential loss? Build a portfolio that you can live with in multiple scenarios, rather than betting everything on one. Focus on what you can know, the quality of the companies you own, not on what you can't, the direction of the macroeconomy. Trap 2. Confusing luck with skill. Marx tells a great story about a coin flipping contest. If you get 1,000 people to flip a coin once a day, after 10 days, by pure chance, about one person will have guessed right 10 times in a row. That person might start to believe they have a special talent for flipping coins. They might even write a book called How I Mastered the Coin Flip. But it wasn't skill. It was just luck. They were a lucky fool. The investment world is full of lucky fools. In 2021, you could have thrown a dart at a list of tech stocks and made a fortune. Many people confused that bull market luck with personal genius. They took on more risk, used leverage, and when the market turned in 2022, they gave back all their profits, and then some. How to spot the difference? True skill shows up over the long term and through different market cycles. A skilled investor does well in bull markets and, more importantly, loses less in bear markets. A lucky investor gets wiped out when their luck runs out. As Marx warns, Never, ever confuse a bull market with brains. Trap 3. The diversification trap. This is the most subtle trap of all. Many investors think, I own 20 different stocks, so I am diversified. But if your 20 stocks are all in the same hot sector, like AI or clean energy, you are not diverse. You are highly concentrated. When that one sector goes down, your entire portfolio goes down with it. You have created an illusion of safety. Marx emphasizes that true diversification is not about the number of things you own, but about their correlation. You want to own assets that don't all move in the same direction at the same time. How to diversify properly? Across asset classes. Own a mix of stocks, bonds, and maybe some real estate or commodities. They often behave differently in different economic environments. Across industries and geographies within your stocks. Own companies in different, unrelated sectors, e.g. healthcare, consumer goods, and technology. Consider investing in different countries as well. Just say no. The single best way to ensure diversification is to resist the temptation to load up on whatever is currently popular. Limiting your exposure to the hottest trend is a sign of a mature investor. And so we come to the end. All of these complex ideas can be distilled into 5 most important things on thinking. Be a second-level thinker. Reject superficiality and always ask, why? On goals, hunt for bargains where the price is far below the value. A good company is not a good investment if you overpay. On timing, respect that everything is cyclical. Use the market's emotional pendulum to your advantage. Be fearful when others are greedy, and greedy when they are fearful. On action, be contrarian, but an intelligent one. Don't catch falling knives. Wait for the true, mispriced opportunities. On mindset, acknowledge what you don't know. The greatest risk in the market is being unaware of your own ignorance. Stay humble. In the end, investing is not a race to see who can get rich the quickest. It is a marathon to see who can stay in the game the longest. These 5 principles are all designed to do one thing above all else: control risk and avoid the big mistakes. If you can do that, if you can avoid chasing hype, avoid confusing luck with skill, and avoid being overconfident, and simply buy good assets patiently when the market offers them to you at a discount, your long-term returns will almost certainly be extraordinary. That is the simple, powerful truth that Howard Marks and Warren Buffett wanted us to understand. It is simple to understand, but a lifetime to master. Congratulations, you are one step closer.